Hello everyone, welcome to today's webinar. My name is Chad Robertson, Senior Director out of DMA's Southeast Region. I'm located in Atlanta, Georgia. I've been at DMA for over 20 years now. My background is sales tax and property tax. You're probably wondering why am I here today for an unclaimed property webinar? Well, I'm here to MC the presentation and anything you may need, I'll be here for you. But we do appreciate you taking the time out of your day to join us for the unclaimed property presentation here. We do have two fantastic presenters today with over 20 years of experience, Bud DeLayden and Gwen Lawhorn. They'll do a introduction to themselves later. Interesting fact today, we do have over 300 attendees today, and about half of those attendees are DMA clients. However, some are not DMA clients. So real quick, I'd like to go over some DMA facts in case you're not familiar with those. Here you see DMA was founded in 1972, and we're a proudly employee-owned company. We enjoy partnering with our clients and acting as an extension to our clients' tax department. And most importantly here, as we're doing today, we do enjoy sharing our knowledge with our clients. We partner with our clients in tax minimization, tax compliance, and you'll see here process improvement. Our focus areas are all the areas listed below for state and local taxes, property tax, sales tax, state income, tax technology, and of course, unclaimed property that we're talking about today, commodity tax, value-added tax, and crown royalties. Here, as you see, is a map of US and Canada. We have 20 offices throughout the US and Canada. You'll see the shaded areas in green and then the little dots here. These are the DMA offices, the locations of each office across all the regions. Some interesting facts, as I said earlier, we do have over 300 attendees, and we have attendees all the way down from Florida up to New York over the West Coast, which is fantastic in a webinar setting. We're able to do that, and thank you again for joining us. Without further ado here, let's get the webinar kicked off with our experts. I do appreciate, again, your time. Thank you for joining us, and you're in good hands with Gwen and Bud. And like I said, feel free to use the chat area if you have any technical issues, and please ask any questions you have for the presenters, and we'll monitor that throughout the presentation under the Q&A icon. Again, thank you so much, and enjoy the presentation.
Hello, everyone. My name is Gwen Lawhorn. I'm the Director of Unclaimed Property here at DMA. I'm based out of DMA's Cincinnati, Ohio office. I've been with DMA going on 4 years now. Prior to my roles in the consulting world, I worked for many years inside a corporate indirect tax department, and then also in various corporate accounting roles. Like many clients I speak with regularly, unclaimed property sort of landed in my lap while I was working in the tax department about 15 years ago. And at that time, I found it very challenging to find some solid educational resources, and even more difficult to try to figure out how to navigate the complexities associated with unclaimed property reporting requirements. So I'm always very eager to share, what I've learned over the years to help our clients work through those types of challenges, and also to help them develop a robust unclaimed property compliance process.
Thanks, Gwen. Hi, everyone. I'm Bud DeLayden. Thanks again for joining us today. I'm a Director of Tax Technology Solutions at DMA. So one of the solutions I focus a lot of my attention on is our Unclaimed Property software solution. We'll be shown briefly at the end of this presentation, but most of the presentation is trying to give people an overview on what unclaimed property is, what it means, what your obligations are in that. I've been at DMA for about 3 years, and I've been leading software solutions for a while before that at different companies. Okay. So our agenda for today is we're going to start out with a definition of unclaimed property terms. We're going to talk about types of unclaimed property and characteristics. As you'll see, unclaimed property has its own unique vocabulary. There's unique terms to unclaimed property that before you can understand why a business should care about unclaimed property, you need to understand some of the terminology. So after the terminology and the characteristics, we'll move on to why you should care about unclaimed property compliance and what happens if you don't. Then we'll talk through the compliance life cycle. What do I do to stay in compliance? Talk through different obligations such as due diligence and state reporting, what your record retention requirements are in case an unclaimed property auditor comes in, and what you should do if you haven't been compliant. And then we'll conclude with some best practices and cost-saving tips, followed by a brief demo of our unclaimed property software solution, and then Q&A. And then we have Q&A at the end, but as Chad mentioned, please feel free to ask questions at any time as they're relevant to a slide. Just use the Q&A feature in Zoom, and someone will ask us those questions. So let's start out with a polling question. The first question we have is, how do you currently stay in compliance of unclaimed property law? Our choices here is we do it ourselves using homegrown processes. We do it ourselves using third-party software. We outsource the unclaimed property compliance obligation. We use a combination of do-it-yourself and outsource, or very frequently it's we don't currently report. So hopefully you're not in that fifth category. We won't tell on you if you are, but please take a couple seconds here and answer the questions. It'll help us guide our presentation. We talk with a bunch of clients or prospective clients that start out managing their unclaimed property in a do-it-yourself fashion using Excel spreadsheets. And often when they see their obligations starting to grow, they'll reach out and they'll think about either outsourcing it or using a third-party software solution. Okay, the results. It looks like most people do it themselves, so probably you guys are familiar with Excel spreadsheets and trying to track all the state rules and regulations as they change. Some people do it themselves using third-party software, and then about 10% outsource it and 20% do a combination. So thank you for answering. So we're going to start out with what is unclaimed property. And before we get into the property types in more detail, we're going to start with the definition of terms. Unclaimed property people, the auditors, the people responsible for taking care of unclaimed property compliance, they have their own set of terms that are legally defined. So a holder is the legal business entity that issued the property to the owner and has possession of the property, but not legal title. So what does that mean? It means a holder is typically the business or one of its divisions that has issued a check. Often unclaimed property is a check, but not always. And it's, it leads to an uncashed check. So the holder, the business, say IBM paid a vendor a check for $1,000. The vendor either didn't receive the check or didn't cash it. So in that case, IBM is the holder and the vendor is the owner. So as I said, the business or individual that has interest in the property, oftentimes a check, but not always, issued by the holder and has legal title, but is not in possession. So the holder and the owner go hand in hand, they're tied together. Moving down, state reporting and escheatment go together too. And some people use them interchangeably, but they're really two separate activities. The state reporting or the state report is a list of escheatable properties that are submitted to the state. And the escheatment process is actually transferring the abandoned and unclaimed property to the state. So it's when it says unclaimed property again, often it's the cash value of the accounts or the checks that went unclaimed, but it can also be the contents of a safe deposit box or other tangible property. Property types, Gwen is going to go through those in a bit more detail, but typically it's any account where funds can be issued, payroll, AP, AR, etc. And those accounts live in your various systems to track the different property types. The dormancy period is the period of time without any owner contact or activity that must elapse before a state consider a property abandoned or unclaimed. So that typically, there's various dormancy periods. But for example, if you have a bank account and you haven't accessed your bank account for a period of time, that bank account will go dormant. And the bank will have an obligation to reach out to you during that dormancy period. And then eventually, if you don't make contact, keep that account active, they'll have to report the property, the bank account to the state and the value of the bank account, and then escheat the actual value to the state. The as of date is the date determined by the state in which the property has become stale or dormant. So that's after the dormancy period has expired on that date, it has an as of date. Then the due diligence are the efforts the holder takes to contact the owner to advise of unclaimed property. We'll talk about informal due diligence and formal due diligence a little bit more later, but informal due diligence is not mandated, it's optional, and it's courtesy efforts to reach an owner before the property becomes stale or abandoned. Formal due diligence, different from informal, is required by state law. There's a de minimis threshold or a minimum amount where formal due diligence has to be completed. It's often $50 for many states, but it can vary. For example, Texas is $250. But the owner notifications have to be performed, usually in the form of US mail, but not always, to those property owners before you can do the reporting and escheatment to the states. The first priority rule defines who has first priority on the abandoned or unclaimed property. The first priority rule dictates that the property must be escheated, turned over to the state of the owner's last known address. In the second priority accounts for where you don't know the owner's address, or you don't have current or good information on the owner's location. In that case, the property defaults to the state of incorporation. A negative unclaimed property report is a zero due or no liability due report submitted to the state. Often it's a good practice if you filed in a state to submit a negative report in subsequent years, even if you have no property. So you file a positive report when you do have property, or a negative report if you don't. Just lets them know you're staying compliant, you're staying on top of things, and you realize that you didn't report any properties that year. UPPO or UPPO and NAPA are two organizations we'll talk about a little bit later, but they're really useful resources for people in the unclaimed property field. Asset recovery can be lucrative. You can find lost money. So we have companies that we're working with a company now that's found over $3 million they didn't know they had. We're working with them to recover those funds, but it's basically reclaiming the property escheated by another holder. And then the owner redemption process is simply reissuing the check typically, or the tangible merchandise to an owner after you've done your formal due diligence process. I'll turn it over to Gwen here for a minute.
Thanks, Bud. Yeah, questions we get a lot are, what are some common types of unclaimed property? Well, types of unclaimed property, they can really vary based on business factors such as industry sectors, what are some of your general business activities, what types of internal payment processes do you have? On this slide, these are just a few of the most common types of unclaimed property. The key areas often associated with unclaimed property and what are typically audited the most are the areas of payroll, accounts payable, or vendor or general check disbursements, and then accounts receivable credit balances. But unclaimed property can often include things like third-party non-ERISA benefit plan payments, stocks and dividends, rebates, sales adjustments, and miscellaneous write-offs. And then you can get into the more specialty industry, for instance, like retailers, and you can have things like gift card considerations. Banking has consumer accounts as well as even tangible property in certain states if they're in safety deposit boxes. And then, of course, the insurance sector can also have insurance and annuity payments, and oil and gas could have mineral rights and royalty payments. So it's also important to remember that even if these processes are handled by a third party on the business's behalf, maybe you outsource payroll functions. Well, depending on the terms of those contractual relationships with the third party, that business is likely still considered the holder of the unclaimed property and not necessarily the third party. So it's really important to understand those processes and how they relate to certain business activities you have that could generate unclaimed property.
Hi, Gwen.
Yeah.
Chad, I had a question for you that came through, if you have a second, for you and Bud. The question is, what are the regulations for unclaimed property with foreign vendors?
Well, we'll get into probably that a little bit more detail later, but just to kind of reiterate that first and second priority rule Bud was mentioning, the first priority rule, these were established in a 1965 Supreme Court case in the Texas versus New Jersey ruling. And in that Supreme Court case, it ruled that the first state that has right to unclaimed property is the owners. So in Bud's example, the check, that payee's last known address. So what their last address that they had on file would have had rights to the first priority rule. Second priority rule mandates that if the owner's last known address is unknown, perhaps you've lost some records or as a result of an acquisition or something, need to be reported to the business, the holder's state of incorporation. And many states, including Delaware, do have additional provision that if the owner's last known address is considered foreign, meaning outside of the United States, it would then default to and be reported under the second priority rule to the business, the holder's state of incorporation.
Oh, that's great.
Okay.
Thank you.
Okay. I think we'll go into that a little bit more later through the presentation, but keep the questions coming. That helps keeps the webinar interactive here. So, what are some characteristics about unclaimed property? Well, there's some defining characteristics. First and foremost, the value of the property can be determined. So there is a specific monetary value associated with the property, such as a dollar amount of an uncashed check or an account receivable credit balance. There has to be a fixed and certain obligation between the holder and the owner. As Bud mentioned before, the holder has in their possession the property, but they don't have legal title, while the owner has legal title to the property, but is not in possession of the property. It's personal property. It's usually intangible, but in certain industries and certain states, there may also be tangible property, like contents of a safety deposit box. The owner can't be located. You've lost contact with the owner. They haven't responded to any informal attempts to locate them, such as phone calls or emails. They haven't responded to any formal due diligence attempts. And again, we'll discuss formal due diligence in greater detail later. Or perhaps any formal due diligence efforts were returned by mail. And lastly, the property is dormant. When a property becomes dormant, it's defined by the property type. So for instance, payroll or accounts receivable, and the state that the property should be reported to. Most of the time for general businesses, the dormancy period for properties are typically between 1 and 5 years. So why should a business be concerned with unclaimed property? Well, first and foremost, it's the law. So not adhering to those laws can certainly subject the business and sometimes even the officers to civil and possibly criminal penalties. Many states do subsidize their budgets with the funds received as unclaimed property. Now, the states are required to return those funds to the true and rightful owner if the owner pursues a claim with the state. However, interim of the time that the owner would come forward and make that claim, there's a lot of cash flow, millions of dollars annually, that the states have at their disposal to utilize. Because of this, many states have stringent and punitive audit processes. Again, the state is acting in a fiduciary capacity for the owners, so unclaimed property isn't necessarily considered a quote-unquote revenue generator for the states. This causes the states to oftentimes have a very small budget for any administrative purposes. Because of that, a lot of states utilize various third-party contingency fee-based auditing firms to assist them with any of their auditing processes. And if you're selected for an unclaimed property audit, it wouldn't be uncommon to see the audit being handled by firms such as Kelmar or Veris or Specialty Audit Services, who are going to likely conduct an audit of several states concurrently. The most I've seen up to was, I believe, 36 states at once. From an accounting and financial perspective, just writing off the property could likely violate various accounting requirements. But maintaining these aged and outstanding liabilities on your balance sheet, it could impact the business viability ratios. And with certain property types like AR credits, it could even have pursuing the unclaimed property process could have a positive impact on an incremental revenue stream. If you're able to connect with these owners and have them utilize their credits prior to the reporting as unclaimed property, you're being able to generate revenue inside your business versus just turning that credit into a payment and submitting it to the state. Maintaining and consistently reconciling these cumulative and aged properties, it can be a very arduous and time-consuming task. When you likely could have those resources focused on more business value-add work. What happens if you have system changes? You can lose all your owner contact information. So it can be very challenging for the business to maintain those properties indefinitely as opposed to reporting them. And lastly, of course, there's an element of corporate social responsibility. By regularly reviewing your books and records, you're demonstrating to your employees, your vendors, your customers, that you strive to be in compliance with all the state's requirements.
Thanks, Gwen. So now I'll get into what do I need to do to stay in compliance with the state laws. So the compliance life cycle I'll go into in the subsequent slides, but put simply, you have to identify your unclaimed property. You can optionally do informal due diligence. Then you have the dormancy period. You have the mandated formal due diligence in the state reporting. So the property identification involves reviewing your records to identify property that has become stale. Often, companies will have right processes to monitor their books and records to look for those properties, those checks that have become stale, where they have gone uncashed for a period of time, or accounts that have been unaccessed for a period of time. And it's typically outstanding checks for AP payroll or AR credits. Formal due diligence, and as I touched on earlier, is an optional step. You're not mandated to do it, but it can be a very worthwhile step. It helps you find many of the property owners in advance of the mandated formal due diligence. It's often done via a phone call or an email or even a letter, but often a phone call or an email will do the trick here, and you can save the effort of sending a letter. And that's one of the big advantages of informal due diligence. If you can find those property owners via a call or particularly an email before you have to do the formal due diligence, you don't have all the manual effort and cost associated with formal due diligence that I'll touch on in a moment. So it brings us to another poll question. We'll just take a little bit to answer this one. Do any of you use email to try to locate property owners? Our software Optic does send emails automatically to property owners. And we've seen that people who use that or even send emails on their own, either through a manual process, a mail merge out of Excel, they can really locate property owners in advance of the formal due diligence. But it's, our clients have found the email to be an effective means of reaching the client. It's not a replacement for formal due diligence. If you don't find a property owner, typically you send the email in advance of the mandated formal due diligence. But if you do find the owner here, you don't have to do the due diligence. You can either reissue the funds or reactivate their accounts. Okay, so good. I'm surprised. That's a nice high number. 45% of you do send emails, and about 32% or another 23% either don't or aren't sure. It is a worthwhile step, and then it can really save some time and energy and cost down the road. So the dormancy period, we touched on this on the definition of terms, but its property becomes dormant per the state law as of or listing date. Typical dates for dormancy are March 31st, June 30th, and 12/31, and those typically align with the state's fiscal year end. The states want to get acknowledgement of the funds, get the funds in the door to use in their budget for the unclaimed funds. Generally, the dormancy period is 1 to 5 years from the issue date or the date of last contact based on the state laws and property type. And this is where it can really become a challenge, is to stay on top of those state laws as they change. UPO is a good source of change laws, as well as sometimes you have to monitor the state websites. UPO or UPO, we'll talk about it a little bit at the end of the presentation too, but it's a great resource. It's an organization that really helps unclaimed property owners or holders. Formal due diligence, which I touched on when I was talking about informal due diligence, whereas informal due diligence is optional, formal due diligence is required. And if you have the auditors come in, they'll check to make sure you did the formal due diligence. It's a notification. It's typically a U.S. mail, a first-class mail. In some states, based on some dollar amounts, it can be certified mail as well. So there's even additional cost there, which is even more incentive to try to locate the owner via email if you can before the formal due diligence period. The purpose is to try to directly reissue the funds to the owners prior to reporting it to the state. Each state has a specific format of the letter where the wording and the time period for the letter to be mailed are specified too. So they have a special format, they have a special wording, and then they have a time period just before the property is reported and issued to the states where you have to try to reach the property owner via formal due diligence. Many of the states have a minimum threshold on where you have to do the due diligence, and that's the de minimis threshold. It's typically between $25 and $250, though the majority of the states are at $50. There is some variance, but most states are at $50. If the property value is at or above $50, you have to do formal due diligence, and if it's below, you do not. And businesses, the holders, have an obligation to track the formal due diligence, including the owner's responses to satisfy their audit requirement, if an auditor comes in.
Hey, Bud, we have a couple of questions here. Do you want to go through the polling question first and allow you to go through that when you ask the questions?
Sure. So we'll take a look at the questions that are posted. We'll do the poll first. Do you conduct formal due diligence or the owner letters? Your choices here are yes, we do. No, we just escheat the property. And there are some people that just escheat it and take their chances. And then of course you're not sure or you'd rather not say. But it is mandated. It is the law. And the auditors, if they come in, if the Kelmar or the Barris comes in, they will look to see that you did your formal due diligence. So it looks like 2/3 of you, at least 2/3, maybe more, perform the due diligence. So that's great. So the first question we have is, if you complete due diligence through a phone conversation and a vendor states your company's count is up to date, is that sufficient, or what type of support is required? So Gwen leads our compliance team, so I'm gonna let her answer that.
Yeah, that can be a sufficient source of handling due diligence, meaning, you contacted a vendor, maybe you had an outstanding check with them. A lot of times that can usually be attributed to re-invoicing and duplicative payments and things of that nature. While you've resolved it and you're going to be at that point probably writing off a check or voiding a check, it would be important to make sure that you notated that information in your AP system, who you spoke with, what the date was. If possible, communicate via email so that you have something there. And I always tell clients to be very specific and say, so we do not owe you check number 1999 for $712. And that way you've got something that would directly tie back to the specific property.
When ready to escheat the property to the state, say I'm escheating the funds in November, do I need to send another letter out prior to November? Then how many months prior?
That's a good question, Christina. About 85% of the states do have that October 31st, November 1st filing deadline. Each of the states do set specific requirements when you should be mailing your formal due diligence letters, when you should be attempting it. But most of the times it's 60 to 90 days before the state reporting. So we usually try to get people geared up with reporting in July and August timeframe. You want to make sure that you give the owners about 30 days to respond. So that's from the time the property's dormant, considered formal due diligence, when the properties actually be considered dormant. And then likewise for other states, there's about 15% that report in the spring. You might have formal due diligence requirements that you'll need to be handling in the fall leading up to the spring reporting.
Another question here from Heather. If you have old AP checks from years, can you do informal due diligence?
Of course, any way that you can work to resolve those properties, as long as you're able to keep your documented evidence. But I would highly suggest that before you would just go to do state reporting, that if the informal attempts didn't resolve the properties, that you still went ahead and went along with the formal due diligence requirements, unless of course you have reason and proof that the address is bad or something like that. There would be no need to do it then.
Okay, the next question is from Rihanna. What kind of documentation do you need to keep as formal due diligence proof? Is an Excel file okay?
Typically, it would be ideal if you were able to keep copies of the letters that you generated and sent to the owners. Not necessarily so far as to keep keep track of the date that they were mailed, things of that nature. But that way, if you needed to present it to any state auditor, they'd be able to see how you were communicating it. And especially if you had it for year over year, they'd be able to establish that you had a consistent policy in place. However, if you're not going to be keeping track of all those letters, then maintaining that information in some type of a database, software tool, or even Excel, indicating the dates that you mailed the letters, and then any owner responses would be bare minimum would be sufficient.
The next question is from, it says Jones, I believe. If a company does not follow due diligence and has been filing zero returns, what is the risk if under audit? Gwen, should we come back and cover this one? I think you have a slide covering this.
Yeah, I could just say at a very high level that if you're filing zero due returns, but you have properties that you need to report as unclaimed property, your risk isn't necessarily just associated with the due diligence efforts. Your risk is that you're not reporting properties that you have on your books and records. However, if you have nothing to report and you're reporting zero due, you wouldn't have any formal due diligence requirements.
We utilize a healthcare insurance company to administer our claims and occasionally receive a list with limited information due to HIPAA rules. Due to the lack of data, we have difficulties sending formal due diligence letters. What options do we have to send formal due diligence in these situations? Or do we have to have the healthcare insurance company complete this?
Well, I think contractually speaking, you need to look at the relationship that you have with that healthcare insurance company and make sure that it defines who should be handling that step for you. Now, if it falls on the business and not on the healthcare insurance company to handle those processes, It might be, a quick conversation with them to determine what additional information they might be able to provide. If they're not able to provide you that additional information, then you have to start understanding, where and how can I report? Do I have enough information to make sure that it goes back to the first priority rule state, or will it have to default to my second priority rule state for reporting?
Thanks, Gwen. The next question is from James. If we reach the customer by phone or email, do we need the due diligence letter signed to reissue the check?
Well, no, not from any technical perspective. You don't need a letter signed to reissue a check. However, if it's an aged property and you're going to be voiding the original check and reissuing, that's something that comes up very frequently under audit. So as much documentation as you can put in, can keep track of, it would be helpful, and it would be demonstrating to the auditor that you just didn't have a process of reissuing. Many times, if you just develop that as a simple process and say, yep, we need to have something in writing, whether it be via email or a response to a due diligence letter, you're showing easily to an auditor the justification for the void and reissue.
Is 30 days a standard amount of time to allow the owners to respond, or does it vary by state?
That's a very good question. Yes, Barbara, 30 days is usually your standard amount of time to allow the owners to respond. There are a couple states that do caveat that you might give someone a little bit longer, or it might be pinpointed closer to the due date, saying you have 30 days from the date of the letter to reply, or you have up until 30 days before the property is supposed to be reported. So there are a few nuances there from state to state, but that's generally a good rule of thumb.
Thanks, Gwen. Well, there's a question from Robin, but I think I saw Robin post that her question was answered. So Robin, just let me know, please, if I'm not correct, and we'll come back to more questions later. Thank you. So real quickly on formal due diligence, there are some state-specific rules. California has specific wording, and they even specify the format and the font size required in parts of the letter. Ohio letter must include the nature of the letter, the ID number, description of property, and it must include a self-addressed stamped envelope for properties in excess of $50. New York and actually Ohio and New Jersey have a certified mail requirement for certain properties if the value exceeds a certain threshold. And Puerto Rico has an old rule where where properties are required to be published in the newspaper actually before sheeting them. The new rule is evolving now. And Gwen, I'm not sure, is the Puerto Rico newspaper publication still in effect, or did that expire?
It's still in effect. However, we found last year when we talked to the Puerto Rico Unclaimed Property Administrator that there were several different areas of, how you could get away from it. If you have physical presence in Puerto Rico, they're pretty strict on wanting you to do that publication. However, if maybe you just had a vendor or something there and it wasn't a significant dollar amount, they weren't overly concerned about it. So it's always important, before you go and spend a lot of money in putting these advertisements in the newspaper, because you have to do it twice, and it's per letter on what needs to be published. I always recommend contacting the Puerto Rico administrator, and if you're able to get an exemption for it, to do so. Well, now we get to the meat of it here, the state reporting. So now that you've identified your properties, you've tried to make your contact or your informal contact when the time is right, you've performed your formal due diligence, and you still have these properties outstanding. And now it's time to report the property to the state authority. And so, if you remember, we did explain, Bud and myself both talked a little bit about those first and second priority rules. But just so again, the first priority rule states that the property should be reported to the state of the owner's last known address. And if that information is unknown, it's no longer available. And in certain states, if the address is foreign, then those properties need to be reported to the holder, the business's state of incorporation. For most general businesses, about 85% of the state reports are going to be due in the fall, and the remaining 15% are spread out between March 1st and July 1st. So reports are due for all positive reports. Those are reports with amounts due. And many states do require annual negative zero due reports. Clients usually ask us, well, where do you recommend that we file negative reports? Well, of course, it's important to, file a negative report in your, if it should be required, in your state of incorporation. It's important if you filed previously in another state and they require you to do that year over year. And oftentimes I usually advise clients to look at the states that they are registered to do business in. Who are you registered with the Secretary of State? So that way it goes outside of just physical presence, but where else do you have business presence in those states? You should be filing a negative report if you have nothing to file. Again, it just demonstrates a good faith effort that you understand what the laws and the requirements are there. You should review the state's requirements. You should be able to see if there's any exemptions, deferrals of certain property types, and then understand what the state's filing requirements are. Does the state mandate filing or paying online? Are there any state-specific forms required to accompany the report? Again, the state will be the fiduciary of the property in perpetuity, and the funds could be available, or should be available, I'm sorry, should the owner ever decide to pursue the claim. So the states don't just get to take these into income, they do sit out in their reserve to be able to pay back to the owners. So in the previous slide, I mentioned reviewing the properties for exemptions or deferrals. And I think this is where a lot of businesses, a lot of holders get eager. They're interested to find out, how do I get to keep this and not have to, push this over to the state? Well, let's discuss those in just a little bit more detail. One of the most common exemption or deferral is the business-to-business exemption. Presently, there's about 15 states that have some type of B2B provision in their statutes. Now, this is a law or even administrative guidance from the state that exempts or defers unclaimed property that would arise from, say, a transaction between two legal business entities. Now, that's a very broad definition, and the scope and application of these exemptions do vary greatly just between those 15 states. Several states do indicate that if and once the business relationship were to terminate, then those deferred properties would need to be reported as unclaimed property. So if the business just makes a practice of writing them off, they can get themselves into a bit of a sticky situation if that relationship ever severs. They'd have to go back through all their write-offs and then report those properties to the state. Now, these are good exemptions and deferrals to take from an annual cash flow perspective, but you have to really understand these requirements before you just reclassify the liability, just to make sure you don't have issues years down the road. There are also several states that offer exclusions for certain property types below a certain dollar amount. For example, Kentucky does offer an exemption in reporting payroll-related properties if the dollar value is below $50. I believe that's the same in Illinois. There's a couple states that do offer that. I get feedback from clients who sometimes they might get frustrated with filing the annual unclaimed property reports, like I said, in certain states where they're not doing business. Perhaps they just utilized a vendor one time in a state and they otherwise have no activity in it. And they ask, are there ways to simplify this reporting, or do I have to start filing in that state when I'm likely never going to be filing there again? So in those types of situations, a holder could consider reciprocal reporting. It might be a solution for them. This allows the holder to file, let's say in their state of incorporation, properties that would be due to other states under the first priority rule. Now, it's important to note that the properties still have to be reported in accordance with the state that has the first priority rule rights. It's also important to note that a holder needs to obtain pre-approval from all states involved, as not all states have reciprocity with each other. So let's just say, for example, you're domiciled in Ohio and you don't ever do business in Florida, but for some reason you had a miscellaneous vendor check to someone in Florida. Do you want to start filing in Florida and you want to open that up to where maybe you have to report, or you'll have to remember next year to close your account down? You could look into finding out if you could report it to to Ohio, following Florida's unclaimed property dormancy periods and guidelines, and if there's reciprocity between Ohio and Florida, and would the states accept it? There's a little bit more work on the front end, but it might save you down the road. This is especially important if you have, several states where you want to consider this. It's also important to note that the United States isn't the only country with UP laws and requirements. However, a lot of businesses, they defend not filing unclaimed property in other countries, usually under the Federal Commerce Clause. I think the most common foreign country that comes up in the US when talking about unclaimed property is Canada. Yes, Canada does have unclaimed property reporting requirements. However, presently the laws only apply to banking and life insurance, and they're administered at a provincial level, such as in Alberta, British Columbia, Ontario, and Quebec. However, we have heard recently that Canada is considering enacting an unclaimed property law at a federal level. For right now, most US-based businesses can avoid Canadian reporting by turning those properties over to the state of incorporation under the second priority rule if that state requires foreign properties to be reported. Now, many clients do have Canadian businesses as well. Well, if they're not meeting the business requirements to have, they're not in life insurance, they're not in banking, they may not have provincial reporting. However, Alberta does have reporting for payroll and AP related properties. So if you're a Canadian-based business and you have payees that are in the province of Alberta, you would most likely have a reporting requirement. Another nuance to state reporting is preliminary and final reporting requirements. California and Puerto Rico both have these requirements. In California, a preliminary report is filed in the fall. This is just a list of the dormant properties that remained outstanding after the holder attempted due diligence, and there's no payment due at that time. California actually takes on efforts to perform due diligence themselves by looking up against their different systems and databases to see if they can find those owners. And then the owners have until June 1st to respond. From there, if there's no additional responses from the owner, the holder then needs to file a report between June 1st and 15th, which is the net of the report less any resolved properties. And Puerto Rico does also have some similar requirements. We'll talk a little bit about state reporting. All states now accept reports in the NAPA 2 format. You need to make sure you understand the appropriate method in which to submit your state report. Can it be submitted online? How do you make the payments? Do you need to consider sending a CD or flash drive? And realizing that many states no longer support paper filings. Why is record retention so important? This is a very important question. This is really the only way to substantiate your filing positions under an unclaimed property audit. Most unclaimed property audits have a look-back period of 10 years plus dormancy. So it's very common to see these audits span 15 years or even more depending on the property types involved. Honestly, that's actually a pretty recent development. Up until a few years ago, they could go back, auditors would go back and look from the date the business was started. Do you keep records of unclaimed property or otherwise for 15 years? Well, when you don't have those detailed records requested under an unclaimed property audit, the auditors are then able to extrapolate liability back from current records. So what records should you keep and for how long? Well, we recommend the detailed records supporting the books and reviewed for unclaimed property, such as your trial balances, your general ledger subledgers, bank statements and reconciliation, owner notification attempts and resolutions, and then of course your state unclaimed property filings. And additionally, it's important to keep copies of any contracts you have with third-party providers like we discussed before. Have you ever been subject to an unclaimed property audit? Okay, it looks like we had about 39% have been involved in an unclaimed property audit, and we've had about 30% that say no, 28% that said not sure, and about 3% that opted not to say. What if I haven't been compliant? So before you start going down the road of worrying about an audit, what can I do? What if I haven't been compliant is probably the question I hear most often from clients. First and foremost, I commend any businesses that seek to enter into compliance on their own volition. That's going to go a long way with many states. So after you reviewed your books and records, you've identified your unclaimed property, you've tried to work with the owners to resolve it, you're now ready to understand the steps of initial compliance. There's various programs out there that the states offer to give some mitigation to P&I and potentially even any amnesty, such as voluntary disclosure or compliance agreements. These essentially become self-audits. Several states do work with a third-party firm to help assist them in these processes, so it can be very advantageous for a holder to also work with a third-party firm to advocate on their behalf. Of course, you need to perform cost-benefit analysis, determine if P&I that could be assessed is worth the late reporting penalty, is worth the offset of using a third party. And then there are even states that offer informal processes. But the most important thing is, after you started compliance, stay compliant.
What's the best advice to get the cooperation of AR, AP, and PR departments to comply?
On our next slide, we're talking a little bit about best practices. And I think that's a really important process there. You know, you need to, when you're working on your best practices, you know, you're identifying your key stakeholders, making sure that they're aware of what these requirements and from the state and what they need to be doing. You know, is it assigning a responsibility of reviewing your books and records, communicating that regularly to whomever is going to be doing the reporting? You know, I always say, get a champion. Have somebody that is willing to help stand behind you when you're building this initiative that does have the authority and the ability to get other stakeholders involved.
And Gwen, if I could add too, I think some good advice, Jones, is if you don't get their cooperation and if you do get audited, it can be really, really time consuming and really, really expensive. I mean, the penalties associated with non-compliance in an audit situation can be, and the time commitment can be pretty burdensome. So, I mean, I would think that would be the best way to get them to cooperate. I mean, it could be expensive not to be.
The question was, has COVID affected any UP processes or deadlines, et cetera?
Yes, it has. We've been monitoring that over the past few months. For example, California unclaimed property filings were typically due yesterday, June 15th. They've been extended to August 15th. We've been monitoring and tracking that and communicating that to our clients pretty regularly. But yes, COVID has impacted states' requirements. Remains to be seen what's going to happen with the fall. As of right now, we've not been receiving any communication, but for the spring states, it certainly did impact them. But the next couple slides, I think they're, you know, we can kind of skip through them. There's best practice information. We're going to provide this all over to everybody who's attending today. They can read through that and the cost saving tips. I wanted to make sure we got on to the last few slides for you to go through.
That sounds good. So yeah, I'll pick up here with some of the cost saving tips and I'll go through these super quick. Informal outreach, we already talked about, so I won't talk about that anymore. You know, there's different situations where software or outsourcing is a good option. Your software can take the onus, and so can outsourcing, of tracking all the different rules and regulations. You don't have to stay out of date if you put that in someone else's hands. You know, the software can maintain detailed audit records and generate the state reports and generate all of the formal due diligence letters. They can really hold your hand and walk you through the process. Or, you know, another alternative too is if you don't want to invest the internal resources, if it's some people, you know, it's a side job for them doing unclaimed property compliance. It's often cost effective just to say, here you go, you know, another company can take it off your hands altogether and manage the process for you for a pretty cost effective alternative. So with that, I'm just gonna go through, I was hoping to have 10 minutes. I'm gonna go through, show you guys our unclaimed property software in 2 minutes. And if anyone's interested in a follow-up demo, I can certainly do that. So in this is our software that our internal compliance team uses, as well as our clients that use Optic in a do-it-yourself type fashion. In here, we have a property dashboard or scorecard where I can see all my properties in all phases of the due diligence life cycle. I can import properties in here. Here's after I've imported my properties. They're all in here in all different statuses that correspond back to the dashboard. So here's my dashboard. And if I only wanted to see where do I have to reissue checks, I could click on that number 2. It'll bring me here and say, here's a couple where I have to do reissuance. Or I can clear the filters and I can see all my properties at a glance. All the detail is under here in the links. We have a page dedicated to due diligence. And here you can generate the owner letters. We automatically move properties into due diligence based on the state laws and thresholds. So you don't have to track those. We'll automatically move them in here and we'll give you an active notification in email and in the application telling you it's time to do your due diligence. And I'll just download one of these letters to show you what they look like. We fully generate all the letters in the software or our team. I just made a UP101 logo, but it generates a fully compliant letter for each of the states. Where you just mail this, it has a QR code, so if you get a reply, you can easily scan in the reply. And finally, we have the state reporting. And in the state reporting, I can see a calendar of when reports are due. I can collapse that calendar. I can see my July 1st reports, or I can see all my reports even beyond July 1st into November and October. In here, I can generate the reports. I can download those. For the states that support electronic filing, we can submit them electronically right through the software. So that's a 2-minute demo for the interest of time. But we'll be happy to go through any software or our services in additional detail. I spoke about UPO, the Unclaimed Property Professionals Organization, earlier. And UPO is really a great resource. Check out their website. It's they keep track of the state rules and regulations. They have an active forum. It's not that expensive. It's a couple $100, and it's really a wealth of information. Someone posted the question, does the software have the ability to email due diligence letters? And yes, it does. You can either send those emails out ad hoc by clicking a button, or it can be completely automated and the software sends out emails through your own company's email servers with your own letterhead directly to property owners. So it's a nice feature. Chad, was there something else that we needed to do beyond this, did you say?
No, that's it. Just wanted to remind everyone again to answer whenever you get your event evaluation to fill that out. And thanks again for joining us.
Yeah, there was a question about how does the data download into the software, Bud?
Yeah, so what we can do is we import any Excel file. So if you're generating an Excel file out of any kind of systems, we can map to that format within about 5 or 10 minutes. It's so we have dynamic mapping to files, and we just import Excel spreadsheets. I was going to do that, but we're just a little shy on time. Okay, I think we got all the questions. So thanks again, everyone, for joining. We're going to conclude our session, and feel free to reach out if you have any more questions or any follow-ups.